Hello, and welcome to the show. Let's get the basics out of the way first. I am not a financial advisor. This is not financial advice. This information is intended for entertainment and educational purposes only. So, this video is about MMTLP speculation. A lot of people are thinking, hey, suppose they don't sell the land by the end of the year. Is it the end of the world? Suppose we do a spin-off. I'm wondering, I've titled this Slow Money. But it's not necessarily that bad. Let's see. So, Roller Pigeons did a recent video about what happens if there is a spin-off and what kind of dividends you can expect. It's a really good video. A lot of the math for this video is based upon her video. Check it out. Link will be provided. So, definitely worth watching. So, the TLDR is there's a short-term play versus a long-term play. You can make more money with a long-term play, but there's long-term dividends, that kind of thing, long-term capital gains, taxes, qualified dividends, all that. So that's a TLDR of it. But you gotta wait, is the whole thing with slow money. So, Roller Pigeons did a video, and as is what I usually do, I just take the math that she came up with and put it into a spreadsheet, because I like using spreadsheets. They're easy for me to replicate math easily, and the math makes sense. So anyway, so this is what the spreadsheet itself looks like in a quick snapshot, and I will go over it just to for the sake of clarity. So we start with $80 per barrel oil. And a COGS cost, or the cost of goods sold per barrel of oil, is $25. That means it takes $25 in general for U.S. manufacturers and U.S. drillers to get oil out of the ground anywhere in the world. It takes about $24, $25, according to EIA estimates. That means that there's a gross revenue of $55 per barrel of oil. Okay. Turns out that Torchlight / MetaMaterials has 8 working oil wells. I did not know that. Roller Pigeons mentioned it, and it's a really good thing to know. Each one of those wells right now is doing about $1,500 a day. Each one of those wells is doing about 1,500 barrels a day of oil. That means if you've got 8 wells working at once, you're getting about 12,000 barrels of oil a day, if you were to do that, right? Have those rigs working for 365 days of the year, and you get 4.38 million barrels of oil. Now, Torchlight / MetaMaterials has a revenue interest of 49%. So if you were to take that 4.38 million barrels of oil and multiply it by the 45% and the gross revenue of $55, you come up with $118 million. Fair chunk of change, right? Now, with that chunk of change, you got to pay your various taxes. These involve franchise, mineral extraction, and corporate tax, which together work out to be about 21%. So subtract the 21%, and you wind up dropping from 118 million to 83 million. Still a fair chunk of change. Now, you can depreciate the oil rigs over a 7-year period, according to the IRS, and that means oil companies do that. So after depreciation, let's say, and general and administrative expenses, I call that G&A. Let's say you're down to about 80 million. It's a decent estimate, right? So it's a rough back of the envelope estimate. So you're down to about $80 million. So if you were to take that whole $80 million and split that across 165 million shares of MMTLP, you come up with about 49 cents a share. Not bad. Not great if you think about it. If you think about the fact you're only getting 49 cents. But you're getting 49 cents every single year. This is for 1 year of operation. So what that means is that it's a recurring dividend. So if it does become a recurring dividend, then you have to apply the concept of dividend yield. When people buy stocks and for the purpose of getting a dividend, they will spend a fair amount of money and expect to get a certain yield out. Like, for instance, if I were to spend $100, I might expect a 5% yield from a stock, which means I would get $5 back every single year, right? Kind of like interest. So, as a result, you can work backwards from the amount that you expect to receive, the interest you expect to receive, to what the price of the stock should be for a given dividend yield. With 5% interest dividend yield, or 5% dividend yield, and an annual dividend of 50 cents, that means that the price of the stock on a per share basis should be about $9.70. If you had 1,000 shares, that means that you'll be getting about $485 per year, and the projected value of your shares should be about $9,701. If you had 5,000 shares, it's basically 5 times as much, so you got $2,400 in dividends and about $48,500 in projected value of the shares to obtain that $2,425 of dividend yield. Okay, so that's basically how dividends can cause a value of a stock to be evaluated, right? Now there's 3.7 billion barrels of oil in there. There's only 8 wells, and they're pumping 4.38 million barrels of oil a year. So if you think about that, it would take 844 years to pump all the oil out at that rate. So that means it would probably be a good idea to build some more wells. Just so I speculated, this is all a speculation. If you're going to start working out the dividends and getting money out of that field, suppose you organically build more wells using the working revenue. Because don't forget, we were talking about a large amount of money that was coming in. We were talking about something in the range of $83 million of revenue that's coming in, right? So let's see what happens if we let's alter this math a little bit to work that out. First thing I'm going to do is I'm going to remove all the extraneous information, right? So it's just the raw calculation, right? Then I'm going to look at the depreciation and break it out into depreciation of $2.5 million for the current rig setup right now. And I'm going to throw in a factor of general and administrative expenses, basically G&A. So, and I'm just arbitrarily setting a factor of $4 million for G&A right now. Okay. So after depreciation and G&A, instead of having $80 million, you'll wind up with about $77 million. Still a fair chunk of change, right? If you were to take out all of that $70 million and distribute it to all the shareholders, you're talking about 47 cents a share. Still a fair chunk of change, right? Now, suppose you only issued half. Suppose you only gave $38.8 million in dividends, which works out to about 24 cents a share. Okay? And you reinvested that $38 million into new wells, right? You could get, now a well could cost about $4.6 million. Some cost more, some cost less. So if you add 8 more wells, it turns out you can add for $38.6 million about 8 more wells. And that means that you've got a total of now 16 wells. So you'll be pumping more oil with those new wells. So what happens when you do that? I'm going to put this into a... Oh, by the way, your dividend yield, because you're now issuing less in dividends, has dropped, of course, now. So your dividend yield with 24 cents a share at a 5% yield means that your projected share price is $4.69. So your projected share price is lower, by the way. So I'm going to put the whole thing into a column for a spreadsheet, and I like to use a column because that way I can say this entire column is for one particular year of finances, right? So 1 year of finances is in this one column, which means I can add another column for the next year. And in the next year, I'll say, well, we've got 16 wells now, and instead of having oil at $80 a barrel, let's just say the price of oil dropped to even $65 a barrel, right? So now the price of oil has dropped, but we got 16 wells. And we're going to run them, and when you run the 16 wells, you end up with 8.76 million barrels of oil. The previous year you were at 4.38, okay? So now you've doubled your production. After taxes, you now have about, $121.9 million, okay? It's pretty good still, right? Which means that you can send $58.85 million for dividends and take another $58.85 million to reinvest in more wells, which means you can add 12 more wells. Okay? Now your dividend is 36 cents a share. Your dividend yield at 5% implies a share price of about $7.14. This is the end of the second year, right? So, what happens then? Well, let's say the price of oil keeps dropping, and it drops down to $50 a barrel. But now you've got 28 wells because of all the wells you've made, right? Things are, as you can see, accumulating, adding up. This means you now have about 15.33 million barrels of production. Previously you had 8. Previous to that you had 4. Now after taxes, your revenue winds up to be something in the range of $187.8 million. Split that 50-50 between dividends and more wells, and you got about $64 million that you can invest in both. This means you can add 14 more wells, and your dividend works out to 39 cents a share. Okay, we're starting to get up there now. A 5% dividend yield means that your stock price is valued at $7.82. That's really interesting now at this point. Now, let's jump ahead to 6 years. By the end of 6 years, you keep doing this. If the price of oil is still at $50 a barrel, hasn't moved much, let's say, you've now added about 95 wells. Okay, you're now at the 95 well mark. You're producing 52 million barrels of oil. After various taxes and revenue, you're looking at $452 million. That means that you got about, if you're going to split that between dividends and more wells, you got $223 million you can give out in dividends and $223 million you can reinvest in more wells, which means you can make 48 more wells. You can drill out 48 more wells now. Now your dividend is now at about $1.36 a share, and a 5% dividend yield implies a share price of $27.12. That's pretty decent, okay? Now let's say that you're going to go out beyond 6 years even. Okay. Oh, well, okay, let's not go there yet. If you had 1,000 shares of MMTLP at that time, that means that your dividend is around $1,356, and a projected share, with a projected share price of $27, you're looking at $27,000 in value, right? If you had 5,000 shares, the numbers, of course, increase by a factor of 5. That means you're getting about $6,780 in dividends, and you've got a projected value of shares of $135,000. But wait, all of this is subject to, now, long-term capital gains and qualified dividends. This is a lower tax rate. This means that the first $40,000 of income in terms of qualified dividends is tax-free, 0%. If you were to sell the stock, right, the first $40,000 is tax-free. However, the up to $445,000, you're only paying 15% in federal taxes on, right? And if it becomes more than $400,000, of course, you're limited to 20% tax rate. That's because you have invested for the long term. You've tied up your money for a long period of time, and the government gives you a tax break for taking that risk. So let's say that you leave it in there for even longer and you let it grow even more. And let's say that they keep adding more wells, okay? What happens after 10 years? By year 10, you've got 495 wells, okay? You don't need to build any more wells at that point. You got enough wells. You're pumping 271 million barrels of oil per year by year 10. If oil is at $50 a barrel by year 10, that's $2.35 billion that gets distributed in dividends. And quite frankly, 10 years from now, the price of oil, I think, is going to be a lot more than $50 a barrel. Because people have been saying that we're going to run out of oil. And if we run out of oil, the price of oil goes up dramatically. Okay? Anyway, so on a per share dividend basis, right, that that $2.35 billion that gets distributed in dividends gets split across 165 million shares, and that means it's $14.25 per share. With a 5% implied yield, right, with a 5% yield, the implied share price is $285. If you had 1,000 shares, that means you have the projected value of your shares is $285,000 in year 10. Okay, with dividends of $14,225. That's only with 1,000 shares. If you had 5,000 shares, the numbers are 5 times as big, which means you're getting $71,000 in dividends, and the projected value of the shares is something like $1.425 million. And again, all of that is subject to long-term capital gains and qualified dividends. So you're being taxed at the lower tax rate. So again, if you decide to cash out somewhere in the range of, I don't know, the first 40,000 is, you're not paying any taxes on. Between 40,000 to 445,000, you're paying 15%, and above 445,000, you're paying 20%. So that's a pretty good tax rate. So you're getting rewarded both by the share price increasing, the dividends increasing, the number of reinvesting and all that. So it's really not bad. But you got to wait 10 years. So I call that slow versus fast money, right? Slow money is really not bad. It just takes it takes some time, right? It's still really good, right? But yeah, me personally, my personality, I prefer fast money. So that's just the way that my brain works, right? But yeah, something else has been happening that I wasn't aware of, and I became aware of it just recently. And yeah, there's something happening here in the Orogrande Basin, and what it is ain't exactly clear. So on Twitter, this guy called C-Plant, he's got a really good avatar of Clint Eastwood here. It says the Turn Dissous Fund. I don't know what it is, but anyway, he shot off a tweet that said, "This is interesting. Pioneer Natural Resources sells off the Delaware Basin assets for $3.25 billion in third big deal of 2021. Okay, some more oil land is getting sold. And he says, here's what it means to MMTLP shareholders. Okay, so he made up a quick spreadsheet here. Okay, he basically said, look, it got sold for $3.25 billion. They had 92,000 acres, $35,000 an acre. And in terms of if you were to take that same $3.25 billion, give it at a 15% discount, and you bought the Torchlight land, you would get more acres. Okay, you'd spend less money, get more acres, and you'd be getting at least $16.75 in dividends. If you were able to buy the Torchlight lands at a 25% discount from the price of the Pioneer sales, then that means that you're looking at about a $12.56 dividend that could be paid out to MMTLP shareholders. Okay. Personally, I would think that it would sell for more than the Pioneer sales because you get more land. There's more potential. There's more potential oil. So, but these are like minimum numbers as far as I'm concerned. But who knows? This is not financial advice. I'm not a financial advisor. Again, this information is intended for entertainment and educational purposes only. So he says, MMAT released a Kraken. You thought the Pioneer deal was big. Wait till you see this. So they have 8 wells under permit. Let me go back. They have 8 wells under permit with Hudspeth. Hudspeth is a fully owned subsidiary of Torchlight, which is fully owned by Metamaterials. Okay. Anyway, 6 wells were previously reported. It looks like we've got 8 wells are operating. And that means 2 more wells have now been permitted, okay, since November 1. They're both re-entry wells, so they were previously drilled by Torchlight. And one of the wells is called Rich A11. Wells have names and all that, whatnot. So he's got the listing over here of what the wells are in terms of their names and whatnot. So if you're Metamaterials and you're trying to sell the land, you have no real reason to re-drill the same well. Again, you trust the numbers. But if you're buying or thinking of buying the wells, you might want to go down and re-drill them. Make sure that you've got enough oil there. Well, drilling wells is pretty expensive. It's something like 2.6 million or to 4.6 million dollars, depending upon how you do it, I guess, to actually drill them out. But if you're looking at spending multiple $1 billion, spending $2 to $4 million just to verify the assets, it's really not a lot of money, and it's probably worth it. It's like if you're going to buy a car, and you want to check it out with a qualified mechanic, you might spend $100 or so on a car that's, I don't know, $20,000, $10,000. Make sure the car is good. You pay the mechanic $100. He tells you all the problems he's found, but he also tells you it might be a good deal, right? That kind of thing. So anyway, so C-Plant made another tweet. He said, "Release the Kraken. You thought the Pioneer deal was good," and then he talks about Rich A11 here, and it was originally drilled in 2015 by Torchlight, and then recompleted again in 2018, and they're going to drill deeper again. And he wants to prove, he thinks that it's being drilled to prove something for an interested party. It probably, you're not going to spend money unless somebody wants to know something, right? So somebody's interested and somebody wants it drilled, and they're probably paying for it as well too. You never know. So he's got some deals on Rich A11. He's got some info on Rich A11 here. This is the info he's got. It talks about rock stuff. So what happens is that when you drill down and you find a mineral resource, you're like, yay, we found it at this depth, right? But it might keep going down for a longer depth than you've drilled at. So you actually want to drill deeper to find out how deep that resource is. How much can you get out of it? So the deeper you can drill, chances are that you will find more resources down there, right? There's a mining term for it. I forget what it's called, but it basically means that they found the top of the resource, but they don't know how far deep it goes. So it might go down a lot more, and there might be a lot more stuff down there, right? So here he is. He's looking at more drillings. Release of Kraken. Each time it was drilled a little. So apparently this this particular well has been drilled a little bit deeper every single time, and they keep finding stuff apparently. So I don't know. It's someone spending money because they really are very interested in how much oil there is down there. So let's see. And his last tweet was a checklist, actually. He did a comparison of Rich A11 and looked at the Orogrande checklist, and you can look through the checklist. I'm not going to go through it in detail. But apparently someone's looking at this lease very hard. They want to know how much stuff is down there, because it could be that they're getting a deal if they just pay what's being asked, Drilling 8 wells is it's a major commitment. If you own the land and you're trying to sell the land and you already have the reports, you have no reason to keep drilling more. You have no reason to keep spending more money to drill. But if you're buying the land, you have a lot of reason to make sure that there is oil down there, and so you will spend the money to have it drilled. So yeah, some money's being spent down there. So the activity could be due to someone doing their due diligence on a multi-billion-dollar deal. That's the whole thing. And if that happens, we could be seeing fast money by the end of the year. So anyway, so this is all a speculation video. Will there be a spinoff? What happens if there is a spinoff, and what maybe we'll actually wind up selling the land. Either way, in either case, I don't think it's the end of the world. You make basically it looks like you're making money either way. Again, so this is not financial advice. I am not a financial advisor, and this information is intended for entertainment and educational purposes only. Right? This is all a speculation. Nobody knows the answers, and don't rely on this. Do your own due diligence. Check everything out yourself. And that's it for this video. Goodbye.